Which brings me to last Wednesday, when the short-focused researchers at that place, Spruce Point Capital Management, published a 125-page presentation on this company, on Lightspeed. These guys conducted a forensic financial and accounting review, and what they found, I think, is disturbing. Let me walk you through the allegations. First, Spruce Point, remember, they want the stock to go down, says that Lightspeed massively inflated its business pre-IPO. Those are their words, not mine. Before it came public, it seems like the company had a history of making exaggerated claims about its gross transaction volume, its customer count, even the number of offices it had. But that's in the past, and the disclosure rules in privately held companies are a lot less stringent. Second, Spruce Point notes, quote, evidence of slowing and declining organic growth and business deterioration through IPO. These researchers allege that Lightspeed has changed the way it calculates average revenue per user to make it seem like that number's growing. They even quote an anonymous former employee who claims the average revenue per user as a whole is actually declining. On top of that, management used to say that cash flow from operations was the best way to measure the company's path to profitability. Then they stopped providing cash flow guidance. Suboptimal. It also looks like Lightspeed changed its revenue recognition policies. Oh, man, shortly after its March 2019 IPO. Spruce Point thinks they did that to juice the numbers. Third, they accused Lightspeed of wildly overpaying for its recent acquisitions in order to cover up its declining organic growth rate. Now, I don't know if that's true, and Spruce Point highlights a ton of issues with the takeover targets. Plus, generally speaking, it's very difficult to acquire and integrate lots of sizable companies in a short period of time. Lightspeed's trying to do something very difficult with its takeover spree, so it wouldn't surprise me if there are some rocky moments here. In the end, Spruce Point views Lightspeed as, quote, a poor man's Shopify, one of our favorite companies, one that they're betting will face increased competition from the likes of Square, Adobe, Amazon. They think the analysts who follow Lightspeed are missing this story because it's a Canadian company, and in their view, Canadian analysts are too nice. Now, Lightspeed published a formal response last Thursday where they claimed Spruce Point's report is full of inaccuracies and mischalculations. But when we reached out to the PR representative to see if they wanted to respond to the allegations directly, the company declined to do so, which is pretty outrageous given that we recently had them on the show. However, the stock has a bunch of analysts, defenders, who jumped in to argue that Spruce Point's thesis is overblown, which is why they think Lightspeed's worth buying the weakness. My view, even before the short report came out, I thought Lightspeed was too expensive and told you so. The stock deserved to pull back hard. Even at these levels, it's trading at 25 times not earnings, but sales. That's pretty expensive for a company that's facing more and more competition in what I think is a slowing industry, given the huge cost of opening a new restaurant right now. Here's the bottom line. I won't tell you to bet against Lightspeed. I'm not a short seller recommendationer. Because there's too much that could go right. But this is a stock that has become a savage battleground, so I think you should stay the heck away. It is just too risky, people, even if you forget about all the funny business that Spruce Point's accusing them of. The stock had a good run. It is time to move on.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.